AI spending is set to double next year, and everyone is chasing NVIDIA and AMD. But what if the real upside is hiding in companies like Micron and Applied Digital? I mean, Micron is trading at around $226, and it's up about 166% this year. Its data center revenue jumped 137% to more than $20 billion, and analysts think it can hit $325 a share. And Micron's flagship product is already sold out. At the same time, Applied Digital, they locked in more than $16 billion in long-term leases with hyperscalers who need compute power yesterday. And I'm still excited about what's happening, especially since there's a metric, right, that I'm paying attention to, and it'll tell you if this boom is real. It's not earnings, it's not guidance. It's the supply pipeline that's tied directly to AI infrastructure orders that hyperscalers cannot afford to wait for. And then there's something I'm watching that I haven't heard anyone talking about it. If it keeps moving this way, both of these stocks would have way more room to run. That's why in this video, you're going to learn exactly why these two companies might be some of the biggest winners if AI spending actually doubles, and what the numbers actually mean before you decide to invest. Hey, what's up? My name is Rick Orford. If you're new to the channel, I've been trading since 1999, and no, I'm not a financial advisor. That's a good thing, because I break down the numbers to help investors like us make smarter, more confident decisions with our money. Before we continue, I wanted to take a moment to thank our friends at Investing Pro for sponsoring this video. Now, I'm sure that you've guessed that I spend a lot of time working with information and just trying to make sense of the markets, especially for the videos that I publish on this channel. And I found this platform to be an exceptionally valuable resource. Here's why. Inside Investing Pro, you've got access to over 1,000 financial metrics, multiple valuation models, and a wealth of data that's presented clearly without noise or any distractions. It even lets you evaluate companies based on the fundamentals rather than on sentiment, which is something that I absolutely love. And if that's not enough, they've got another tool. It's called Warren AI, and it lets you ask direct, nuanced questions about any company. And then it gives you concise, data-driven explanations, something that would otherwise require combing through tons of lengthy reports. Of course, if you prefer a more systematic approach, check out ProPicks, as it offers more than 80 AI-driven strategies across 20 global markets. And many of these strategies have demonstrated long-term returns north of 25% a year, which is really impressive. Heads up, Investing Pro is currently running their largest sale of the year, so you can access the tool at a 55 to 60% discount, plus an additional 15% through our community link. So if you're looking to deepen your understanding of the market, now is an excellent time to check out the platform. So let's get it out of the way. If AI spending doubles next year, the biggest winners might not only be the chip designers that everyone is chasing. Some of them are most likely going to be the ones that are supporting AI, like Micron Technology and Applied Digital. And that might surprise you, but stick with me for a minute, because industry analysts are forecasting that AI infrastructure spending will hit as much as $6.7 trillion by 2030. That is a tidal wave of money, and not everyone is prepared for it. Hyperscalers like Amazon, Microsoft, and Google, and other cloud service providers will account for the majority of that spending. And when they open their wallets, that ripple effect is going to be massive. Now, memory and physical data centers, these are the unglamorous foundations that make AI advancement possible. But every AI model needs somewhere to compute and somewhere to store massive amounts of data. So there's no shortage in demand here, right? Companies are literally throwing money at AI infrastructure as fast as they possibly can. The only question is who can actually keep up. And I mean, the real problem is supply and execution. I mean, companies are sold out and can So can they actually deliver that infrastructure that hyperscalers desperately need? Well, let's talk about the not so mainstream companies that might actually benefit from increased AI spending, because this is where things start to get a little fun. Look at Micron. Micron used to be a cyclical commodity memory company. Today, it's become an essential AI infrastructure supplier, and their numbers, they prove it. And of course, this shift didn't happen by accident, right? Look at the data center revenue. It now represents 56% of their total sales. In dollar terms, data center revenue rose 137% to $20.75 billion. At the same time, the stock trades around $226 a share. That's up around 166% year to date and over 300% in the last 3 years. And analysts see way more room for the stock to go, with a high target price of $325. So Wall Street clearly thinks this isn't done. What's driving all of this growth, right? Well, it's something called high bandwidth memory, or HBM. And these are just memory chips stacked on top of each other and then attached directly to the AI chips that are used in data centers. And this lets data move incredibly fast between the memory and the chip. Micron's HBM3E memory is completely sold out through the end of this year, and revenue from their HBM products is running at nearly $8 billion annually. Management expects HBM revenue to grow every single quarter for fiscal 2026. And that is a very rare consistency in a booming yet chaotic sector. See, every AI model needs more memory as it scales up, right? NVIDIA's latest Blackwell needs HBMs stacked right on the chip to feed data fast enough. Without enough HBM supply, the entire AI training process hits a bottleneck. And this is the choke point that investors need to be watching. Perhaps Micron saw this early on and they invested heavily in production capacity. They're one of the pioneers producing high volume, low power memory for data centers, which gives them unique positioning today, right? They built the factories before the gold rush even started. How smart is that? And Micron is the only American-based memory manufacturer. So they're expanding factories in Idaho, New York, and Virginia. And this domestic production means supply chain security for hyperscalers, which they really value. Now, why on earth does this matter? Well, it's because hyperscalers want guaranteed delivery without geopolitical risk. So let's talk about the valuation. Micron's forward PE is around 12 times, just 12, which is significantly lower than the industry. So the market hasn't recognized the company's indispensable role in AI. And the low PE plus high demand, it's a combination that investors can only dream about. And it's right here. Of course, the other company that I'm talking about is Applied Digital. This company transitioned from a crypto mining business to building AI data center infrastructure. Early investors, well, they've gotten rewarded very well with gains north of 1,200% over the last decade. And the pivot wasn't luck, it was survival. Right now, the stock trades at about $24 a share, and this will likely move higher as AI spending is set to double. But the market right now is betting on flawless execution. Now, last month, Applied Digital announced a $5 billion lease agreement with a US-based hyperscaler. This is for 200 megawatts of capacity at their Polaris Forge 2 campus. And the lease runs for about 15 years, and it follows an $11 billion contracted lease with CoreWeave for 400 megawatts at Polaris Forge 1, something I've covered in a recent video, which you can check out up here, and discussed over my Discord channel. Now, the company has 600 megawatts of leased capacity across North Dakota. But get this, their total pipeline approaches 4 gigawatts when you include their planned expansions. The hyperscaler leasing Polaris Forge 2 also gets the right of first refusal on an additional 800 megawatts, and that represents the full 1 gigawatt expansion potential of that campus. So demand isn't their issue, it's delivery. So what's important? To get this right, it's execution speed. When hyperscalers are racing to secure AI compute capacity, whoever delivers infrastructure fastest wins the contracts. And fortunately, Applied Digital built purpose-designed AI factories with liquid cooling systems. These support rack densities at over 120 kilowatts. And when I was reading this, I learned that it means that they just can run hotter, heavier AI loads without melting the power grid. At the same time, their North Dakota locations, they offer some major advantages, right? Abundant power availability, low electricity rates, and minimal water usage through innovative cooling. And these factors will allow Applied Digital to bring capacity online faster than the traditional data center operators. That speed is their entire edge. However, the company, Applied Digital, is still unprofitable. They posted a net loss of $16.9 million in the first quarter of fiscal 2026. That works out to 7 cents as a loss per share. And right now, they pretty much rely aggressively on financing to fund their construction. The company also recently pulled $112.5 million out of a $5 billion preferred equity facility with Macquarie Asset Management. And they also announced plans for a $2.35 billion secured note offering. Of course, the valuation also tells you everything about what the market expects. In fact, Applied Digital trades at roughly 41 times its price to sales. I'd say that's relatively rich for a company that's yet to profit. When a stock trades this high on sales, investors expect explosive future revenue, not steady growth. Now, if the company delivers the 600 megawatts on schedule and converts those leases into steady revenue, the stock I could see multiplying several times from here, especially if AI spending doubles in the following years. But one bad quarter could hit the stock really hard, so timing matters. So which is a better buy, Applied Digital or Micron? Well, if we look at the analyst ratings, a consensus among 37 Wall Street analysts rate Micron a strong buy with a high target price of $325. It suggests as much as 39% upside from the current levels. If we look at Applied Digital, it's also rated an average strong buy, except only 10 analysts cover the stock. Now, the high price target for Applied Digital is $56 a share, and that translates to roughly 135% potential upside. So smaller coverage means less consensus, but it also means bigger opportunities for mispricing. And sure, there are risks around each company, but if AI spending were to double, I think these two are some of those that could benefit the most, apart from the headline companies like NVIDIA and AMD. But which one is actually better, right? Applied Digital is building the new type of data center, and execution is going to be key. In their data center, they're going to lease space and power to their customers, and that's great. AI needs lots of data centers to run, right? But consider this. Anything that touches AI needs memory. Anything. For every server, every data center, anything that touches AI. So I think Micron would be a safer bet, but Applied Digital might be the one that's a little bit more volatile. It might have a more chance for a higher return. But what about you? Which one do you think is a safer buy? Do you buy both? Do you buy either? Let me know in the comments below. And while you're there, if you found the video helpful, do like and subscribe because it'll help others find the video, it supports the channel, and you won't miss out on any of my future videos. Well, folks, that's it for me today. I wanted to thank you so much for watching, and I'll see you next time.